Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So this is part 2 of the video that I did in the last video, and what I want to talk about is the dividend growth companies. And in that video I gave you 5 reasons, okay, why it's good to be a dividend growth investor. We've talked about that, and then I've shared with you 5 different companies that have increased their dividend from 11% to 15%. Today I'm going to start with the ones that has increased their dividend from 16 to 29, almost to 30%. But before I do that, okay, like I've always said to you guys, please, it will be really helpful for the channel if you first of all like this video and all the other videos that you've watched so far, and at the same time just join us in the Discord, join us in the Patreon account, and then join us on the Discord. I'm trying to build a community of like-minded people who will actually, inshallah, help each other and hold each other accountable, inshallah, when it comes to this madness of investing in the stock market and so on, right? So let me show you one thing. So this is my actual portfolio. This is in the Simply Wall Street, Simply Safe Dividend, sorry. And what I've done here is, this is my portfolio. So the passive income is my portfolio here. Okay, let me show you the overall so you can see that. And what I want to show you now is about $80,000 or whatever it is right now. Oh, by the way, I just forgot to tell you, I think I've shared this with you guys last video. I've crossed now 69,000. So inshallah, we're heading to towards 30,000 very soon, inshallah. Right, so this is where we are. So this is the based on the dividend growth companies that I own right now. This is my projection, okay, for basically almost 10% growth every year. Now if I turn on, so this is just without having the dividend reinvestment. So I do reinvest all my dividends still. So if I turn this on, okay, now that changed, so get 3% boost. So it changed from almost 10% to right now 13%. And in 20 years, so 2043, I would be expecting to receive at least 20, let's call it £25,000 in dividends every single year, right? Now that can easily change if I then say, do you know what, I'm not done adding money to this account and I'm going to add, okay, 10,000 every single year, just 10,000, okay, nothing more, nothing less, okay, right? I said 10,000 and just disappeared. What happened there? Okay, so just gonna add 1,000 a month. Sorry, okay, sorry, 10,000. Here we go. So if we're adding 10,000 every single year, okay, and we are getting this much, so which is about 12%, 13%, let's call it, okay, it doubles from 25 to right now, basically to in 20 years 46,700. So this is what the dividend growth, why it is important. When you get in almost a 13% increase on your investment without having to do anything, because all you're doing is buying quality companies that increase the dividends, that are dividend aristocrats, dividend kings. They take pride in basically increasing those dividends, right? And you hold them for the long term. You're not worried about the price fluctuations. You're not worried about where the company is going down or whatever, the overall market. If the company is still doing well and increasing dividend and you hold on to it, your yield on cost will basically increase. Your overall dividend growth will increase. And this is the type of thing that you expected. Yes, 20 years from now on is a very long time. But again, inshallah, but by then I'll be, 55. So it's still young, right? So you have to really think about these things and think about the bigger picture, okay? And this is why I absolutely love dividend growth investing. And if you do this and you have this sort of a mindset that I've developed in the last 3 years, genuinely, you will love the red days. Like today, if it was all red, I would be excited and thinking, you know what, I'm gonna put some more money to work. But we all are basically very emotional people. We just worried about what might happen to our stocks and this and that. So don't worry about these things. We'll take care of ourselves. Focus on buying quality companies that have excellent free cash flow and so on. Right, I've already shared with you the other 5. So go and watch that video. So we're going to start number 6 from here. And like I said, we're focusing on the yellow, and that is now 16% growth. So we got Home Depot. It has a wide economic mode. It's a huge company, $288 billion market cap, very predictable business, one of the biggest home retailers in the US and so on. currently paying almost 3%. Okay, 3%. If you're in the Discord, I know you know what I've done with it the last few days. I bought more of this company. I actually really like this company. It's come down quite a bit recently, and the latest increase was 10%. The 5-year growth rate of 16%, and the payout is only 47%. Right, 14 years of increasing that dividend, and you get $8.36 for holding a share of that business, and 87% safety according to Simply Safe Dividend. Now, they have $11.5 billion of free cash. They have quite a bit of a debt, but they have enough to EBITDA to actually cover that. And then when it comes to fairly valued right now, when it comes to Morningstar valuation, 267 is where they expected. It's slightly higher than that where it is right now. Next company is a Texas Instruments Incorporated, and this is one of the semiconductor companies. 164 billion market cap. It has a wide economic moat, and it has 2.69% dividend yield, and they have increased that dividend 7.8. Let's call it 8% latest increase, right? 17% of basically for a 5-year growth rate of 17%, which is absolutely huge. And then the payout ratio is 48%. Which is, again, it's not that big, right? The dividend streak of basically 19 years. So another 6 years, they'll become dividend aristocrat, which are companies that have increased their dividend 25 years or more. Annual payout to almost to $5 and almost to $6 billion of free cash, okay, right now. Again, free cash flow is one of the important things. Like I said in the last video, I am going to record a video about the importance of free cash flow here. But it's one of those things that every single company you own should have excellent free cash flow. Otherwise, what is the point of owning a business that's not going to make you money, right? Fairly valued right now, $168 per share is where the price should be. Visa is the next company, one of my favorite companies out there. Huge company, $459 billion market cap. Latest increase, the dividend yield is very low, below 1%. It's been like that for a long time, but it's getting there. It's increasing. Latest increase was 20% and 18% in the last 5 years, which is huge. 21% payout ratio. Again, they've got massive room to increase that if they wanted to. 14 years of increase in it, and $1.80 is what you will get for every share. Safety is 99%, and you've got $17.7 billion market, basically free cash flow to pay off that dividend, to buy back their own shares and all of that stuff, right? Fairly valued right now, $229. Next company is the MasterCard. How can you separate these two? It's always the same. The market cap is slightly, Visa has actually got a bigger market cap, but when it comes to everything else, I mean, they're more or less the same. The dividend yield is 0.63. The latest increase was 16%, which is less than what in Visa did, but almost there, right? 18%, 5-year growth rate of 18%, just like Visa. Okay, 19% in terms of payout ratio, 11 years of increase in it, $2.28, so it's slightly paid a little bit more. Safety, 99%, okay, which is really good. $10 billion of market of free cash flow there. And then fairly valued right now, $369 per share is where it should be. The final company is the one that I own. I'm sure you expected this to happen, okay? Broadcom, one of the biggest dividend payers out there right now. Absolutely amazing. It's a technology company, $2.90. So almost a 3% dividend yield, and 12% of latest increase was 12%. 29% 5-year growth rate. Massive. 44% payout ratio. 12 years of increase in it. $18.40. How is that even possible? 67% safety, and they do have the cash, okay, $16.8 billion of cash, okay. If the deal though for VMware goes, I don't know how much this will decrease, but we will see what happens. Fairly valued right now, $640 per share is where it should be. Right now, $635, $5 less than where it should be right now. There you have it. That's the final 5 companies that I wanted to share with you guys. One thing they have in common, these companies, is the free cash flow. They have been increasing these dividends. They taken pride in increasing it every single year. The payout ratio is not that much, okay? And the majority of them have a predictable business, either predictable business or they work with some of the biggest companies in the world, like the Apples and so on. So I love these companies, and I'm telling you, I own majority of these companies. I don't own MasterCard or Texas Instrument right now, but it's the companies that have always been under my radar. And the reason I love these companies is because of the free cash flow and everything else that they offer. So there you have it, 10 different companies, 2 different videos. But I want you to remember, it's great to own high growth companies, so the companies that are flying, but that should be about 4 or 5% of your overall portfolio. The rest of the companies should be at least a dividend growth stocks, because remember, if you think about it, Visa and MasterCard are still growing. Okay, the fact that they're growing their earnings this much, okay, it's still a growth company, but they're also growing their dividends. They have excellent free cash flow. You're not worried about this company. You're not worried about this, anything happening to this. They're not CrowdStrike. They're not these type of businesses that need cash. They're not burning cash, these guys. They're making cash and they're paying that cash back to the investors. And that's all we want. Okay. I hope this kind of makes sense. I'm passionate about this because I know what it can do to you, because I'm going to do a video next couple of days and you will see how much I made just this month from dividends only. I made more money this month in basically doing that actually than anything else. So it's really important to think about and have a actual goal, especially if you're young and you're starting right now. Yes, you can have your growth companies here and there, but majority of your money should be, maybe if you're still very, very young, maybe 10%, 15% have those, companies that have a positive earnings, but they are high growth companies like the Nvidias and so on, right? They have higher valuations. Obviously, be careful with that. If you feel like they've got to the point where they are on your watch list, they come down quite a bit, they hit you the price target, then those are okay. Then you can own it. But if you are my age and above and you're looking for retirement, maybe in a few years, 10 years, whatever it is, right? Then you have to think about this type of companies, because what will happen is this. If in 20 years, if you get in 46, let's call it $47,000 every single year from your dividends, can you imagine? You don't have to worry. £47,000 will be way more than what I need for retirement, InshaAllah. Okay, and that will take obviously a long time to build this type of thing, but you have to be patient and you have to have a program. You have to have a plan, if you like. You can't just go blindly look at the stock market. Oh, this one is going up, I'm gonna buy it. This one's going down, oh, I'm gonna sell it. Okay, nothing like that. You just focus on the long term, InshaAllah. And that's advice for me and for you guys as well, for anybody, whether you're young or old, it doesn't matter. This money, this £69,000, go back to my first video. I don't know how much it was. I think less than £20,000, right? But it's been building up, and I want to continue sharing this with you. I want you to know this is not just some made up thing. This is my actual money. I put it in every single week. You see me do these things. Why am I doing that? Because I'm focused on these things. I want to, in 10, 20 years down the line, use these portfolios and retire, inshallah, to use my income from this. Even if I don't retire, at least I can just stop working and do other things, and not retirement, but something else to help the Muslim ummah, anything else other than just like clock in and out of work and so on. I'm going to stop talking. I'm going to stop the video right here. So if you have not joined us on the Discord, please do so. Have a wonderful day. Assalamu Alaikum.